Hi, welcome back to my channel. Today we are going to be talking about the differences between mortgage protection insurance and individual life insurance. Before I go into the difference between those two, I want to talk about a misconception that I often hear from a lot of my clients. People confuse mortgage protection insurance with mortgage default insurance. What is mortgage default insurance? When you want to buy a property and you do not have up to 20% down payment that is the standard required to fund a mortgage, the lender would require that you get a mortgage default insurance to support your application. And that is the insurance that is issued by CMHC and the other private, insurer, in such a way that if there is any default, the recourse from the lender is to the issuer of that particular policy. In this instance, the the premium for that particular policy is added to the mortgage, and that is paid over the period. So, what are the differences between mortgage protection insurance and individual life insurance? Number one, ownership. The ownership of mortgage protection insurance resides with the financial institution that is providing the fund to buy the property. The bank or the financial institution in this instance is the owner of the policy, and they are also the beneficiary of that particular policy. The life insured or the borrower is the payer. So you pay the premium, but the ownership and the beneficiary of that particular policy reside with the financial institution that lent the money for the mortgage to be established. In the individual life insurance scenario, the life insured could be the owner or another owner owns the policy. However, the owner of that particular policy has the ability to decide who the beneficiary is going to be. So the owner could be the same person as the payer, and also the person who gets to name the beneficiary, as against what you have in the mortgage protection insurance, where the bank is the owner and the beneficiary. Number two, coverage amount. In mortgage protection insurance, the coverage amount is determined by the size of the loan that is used to establish the mortgage. For example, if the mortgage is 500,000, the maximum amount of mortgage protection that you can have is 500,000. In the event of critical illness, disability, or premature death, that 500,000 is what is going to pay out the mortgage that the borrower has taken from the lender. However, in the scenario of an individual life insurance, the borrower, in this instance, the owner of the life insurance, can do his own financial needs and decide exactly how much life insurance he or she wants to be covered with. So you will find that people have other obligations that they also want to secure. With an individual life insurance, you are able to put your other obligation under one policy, as against having a different policy while you have mortgage protection in place. Also, with mortgage protection, over time, the coverage reduces as the mortgage reduces, but with individual life insurance, the coverage remains the same, or in some instances it can even begin to go up in a permanent life insurance scenario. Number three, medical underwriting. With mortgage protection insurance, medical underwriting is not done prior to the issuance of that particular policy. The underwriting is done after the claim has been made. In this instance, the life insured has passed, and then a claim is brought forward to the insurance company based on the mortgage protection insurance. It is at that point that the underwriting is done. If the insurance company is not comfortable with the medical condition of the life insured that has passed, they may decide to decline payment on that particular insurance, thereby leaving the mortgage debt with the families of the deceased. In the instance of individual life insurance, the medical underwriting is done prior to the issuance of the policy. As long as the life insurance company is okay with the medical condition of the life insured, and a policy is issued on the basis of the underwriting that is done, as long as the borrower or the life insured or the owner continues to pay premium on that particular policy, even when the medical condition of the life insured changes, the insurance company is bound to honor the obligation they have on that particular policy. Point number 4 is duration. In mortgage protection insurance, the duration of the insurance is the same as the duration of the policy of the mortgage. If the mortgage is for 25 years, then the mortgage protection insurance would also be for 25 years. However, in individual life insurance, you get to decide how long you want your coverage and your policy to be for. You could decide to have a term life insurance that will expire when your mortgage expires or when other obligations that you have will expire. You could decide that you want a permanent life insurance that would expire on the day that you die. But you have that choice to choose whether you want it to expire when the mortgage expires or you want it to be longer than that. In mortgage protection insurance, you don't have that particular choice. And lastly, number 5, changes in lender or sale of property. With mortgage protection insurance, the moment you change lender from bank A to bank B, the mortgage protection insurance that you have with bank A basically expires, and then you have to now take another mortgage protection insurance with bank B if you decide to go with mortgage protection insurance at that point in time. The thing with individual life insurance is if you change bank, your life insurance still remains as it is. You don't have to do anything. You just basically know that you have coverage for the obligations that you have. Also, if you were to sell the property to another person, the mortgage protection that you had from a previous bank that had the mortgage also expires, and then you might then have to take another policy if you are going to be taking another mortgage, even if it is with the same financial institution that you are taking that mortgage from. However, in the event that you have an individual life insurance, that is not the case. Your life insurance is what your life insurance is. Whether you sell your property or you change lender, it doesn't change. You have that for the duration for which it has been set up, and nothing changes as long as you continue to pay your premiums. And that brings us to the end of our session today. I hope by this you now know the differences between mortgage protection insurance and individual life insurance. If you have any questions on what we have discussed here today, please put your comments and feedback in the comment section below. We will be very glad to attend to them. Please share this video with your friends, your families, even with your enemies. You never can tell. Somebody would be able to learn something from this. Please share, like, and comment. We would like to hear from you. We would like to know what you think about what we're doing here. Please put on the notification button so that when we release the next video, you will be immediately notified. And then lastly, please click the subscribe button below and subscribe to this channel. Until next time, thank you and God bless.